In 2025, silver did not simply rise, it surged 148% in a single year, not gradually, not quietly. It moved from below $30 per ounce to above 70, briefly touching levels above 86, before pulling back sharply toward year-end. Movements of that scale do not occur in stable monetary environments. They do not happen because preferences suddenly change. They happen when pressure inside the financial system begins to surface. When silver accelerates this quickly, it does not signal confidence. It exposes leverage, and that is the part most commentary avoids. Because leverage is uncomfortable. It forces attention away from price charts and toward structure, toward liquidity, toward the mechanisms that hold markets together when volatility rises and confidence becomes conditional. If silver is rising while liquidity is tightening, the question is not where the price goes next. The question is what happens when margin requirements begin to rise and collateral becomes scarce. If you want to understand how precious metals behave when liquidity tightens and systems begin to shift, this channel is for you. Most observers focus on the headline number, 148%. They compare it to gold, which also rose strongly, advancing more than 60% over the same period. On the surface, that comparison suggests strength. Beneath the surface, it signals stress. Silver is not outperforming because it is safer. It is outperforming because it reacts faster when confidence begins to strain. History shows that silver moves early in monetary transitions not because it predicts outcomes, but because it reveals imbalance. This distinction matters because price is not the signal. Speed is. Markets can absorb gradual repricing. They struggle with acceleration. When assets move too far, too fast, systems built on leverage begin to tighten. Brokers reassess risk. Clearing requirements rise. Liquidity, which appears abundant during calm periods, becomes selective. This is how stress surfaces before collapse, not through announcements, not through declarations, but through margin. Most silver exposure today is not held in physical form. It exists through futures contracts, exchange-traded products, and layered derivatives. These instruments function efficiently when volatility remains contained. They become fragile when price swings expand faster than collateral buffers. When volatility rises, narratives stop mattering. Markets do not debate long-term theses. They enforce requirements. Capital must be posted. Positions must be maintained. And when liquidity is insufficient, selling occurs regardless of conviction. This is why silver behaves differently from larger markets. It is smaller. Its liquidity is thinner. Its price responds more aggressively to incremental flows. Small reallocations create outsized effects. That dynamic works in both directions. The pullback from $86 toward the low 70s was not a failure of the move. It was a stress test. It demonstrated how quickly leverage can reverse when conditions tighten. It showed how positions held through margin are vulnerable to speed rather than direction. Being correct about long-term dynamics does not protect against forced liquidation. History shows this repeatedly. Markets do not reward patience when leverage is involved. They reward liquidity. This pattern is not new. It has appeared during every period when confidence-based monetary systems encountered constraint. Silver does not create these moments. It responds to them. When confidence in money weakens, attention shifts toward assets that do not rely on promises. But before that shift becomes visible, leverage must unwind. That process is mechanical. It is not emotional. It is not discretionary. As volatility expands, the market begins to separate participants. Those dependent on borrowed exposure are forced to adjust. Those holding assets without leverage are not required to act. This separation is quiet. It does not resemble panic. It resembles transfer. Money does not disappear during these phases. It moves from leveraged positions to liquid ones, from those who must respond to those who can wait. This is why silver is dangerous during periods like this. Not because it is unstable, but because it reveals instability elsewhere. It exposes the limits of systems built on expansion and cheap liquidity. This video is not about forecasting price targets. It is about understanding why silver behaves the way it does when monetary conditions begin to change. Because every time confidence-based systems tighten, the same sequence unfolds. The pattern repeats. History does not need to be interpreted to be useful. It needs to be observed. When monetary systems begin to strain, silver does not invent a new role. It returns to an old one. History shows this repeatedly, across different decades, under different political arrangements, and through different monetary frameworks. The language changes. The mechanisms do not. In the early 1970s, the global monetary system underwent a structural shift. For decades, the United States dollar had been linked to gold through formal convertibility. That link imposed discipline. It limited how far confidence could drift from physical backing. When that connection was severed in 1971, the system did not collapse. Daily life continued. Markets functioned. Institutions remained intact. What changed was perception. Money transitioned from something constrained to something managed, from something anchored to something trusted. That distinction mattered, even if it was not immediately visible. During the years that followed, silver occupied an ambiguous position. It was increasingly treated as an industrial input rather than a monetary asset. That classification held as long as confidence remained stable, but when inflation accelerated and purchasing power eroded at the end of the decade, silver reasserted its monetary role. Between 1979 and 1980, inflation weakened confidence in the dollar. Real yields turned negative. Savings lost purchasing power despite nominal returns. In that environment, silver rose from roughly $6 per ounce to nearly 50. This move was not driven by fashion or novelty. It was driven by reassessment. People began questioning whether money held in accounts would preserve value over time. The pattern was clear. When confidence weakens, silver responds. This sequence repeated decades later during the global financial crisis. In 2008, stress did not begin in metals. It began in credit. Housing markets deteriorated. Banks faced solvency questions. Liquidity vanished where it was assumed to be permanent. Central banks responded by expanding balance sheets and stabilizing institutions through monetary creation. Again, silver did not move immediately. It initially declined alongside other assets as leverage unwound. But as monetary expansion accelerated and confidence shifted from institutions to policy responses, silver began rising. From 2008 to 2011, it advanced from single-digit prices to nearly $50 per ounce. The reason was consistent with history. Silver responds not to growth, but to stress management. It does not rally because conditions are improving. It rallies because systems are compensating. These episodes are often misunderstood because they are reviewed in isolation. Observers treat each event as unique. History shows otherwise. Silver reacts in similar ways during periods when confidence-based systems encounter constraints. This is why silver is misclassified during stable periods. It appears to be an industrial commodity when confidence is strong. During transitions, its monetary characteristics resurface. The shift is not philosophical, it is practical. When money can be created in response to pressure, scarcity becomes relevant again. Silver requires time, energy, and resources to produce. It cannot be expanded by policy decision. This distinction becomes important when monetary expansion accelerates faster than productive capacity. During each of these historical moments, silver did not lead the conversation. It followed stress. It did not predict crisis. It revealed it. The same pattern applies to the present cycle. Unsustainable fiscal trajectories do not announce themselves. They are managed through adjustments. Debt expands faster than output. Monetary accommodation becomes persistent rather than temporary. Confidence remains until it does not. When systems rely on belief rather than constraint, adjustment occurs through revaluation rather than resolution. History shows this repeatedly. Monetary transitions do not begin with collapse. They begin with management. Silver reacts during these phases because it exists outside the promised structure of the system. It is not dependent on repayment. It does not require counterparties to perform. Its value does not rely on policy credibility. This does not make silver exceptional. It makes it diagnostic. Across different decades, different policies, and different institutional arrangements, the sequence remains intact. Monetary expansion introduces fragility. Fragility exposes leverage. Leverage unwinds. Assets that depend on confidence reprice. Assets that exist independently reassert relevance. This is not a cycle of preference. It is a cycle of structure. Understanding this distinction is essential because it explains why silver behaves consistently during moments of transition. It does not need new narratives. It responds to old conditions. History shows this clearly. The pattern repeats. To understand why silver behaves the way it does during periods of stress, it is necessary to look past price and into structure. Markets are not moved by belief alone. They're governed by mechanics. And the most decisive mechanic in modern markets is leverage. Silver operates inside a structure that magnifies pressure. Its market is small relative to other major assets. Daily liquidity is limited. Inventory buffers are thin. Under normal conditions, this structure allows efficient price discovery. Under stress, it becomes unstable. Most exposure to silver today is not held as physical metal. It exists through futures contracts, exchange-traded vehicles, and derivative products layered on top of one another. These instruments provide accessibility and efficiency. They also introduce dependency. Each layer relies on margin, collateral, and continuous liquidity. As long as volatility remains contained, this system functions smoothly. Prices fluctuate, positions adjust, risk appears manageable. But when volatility accelerates, the system shifts modes. Risk is no longer theoretical. It becomes procedural. Margin requirements rise. Clearing firms reassess exposure. Collateral that was sufficient days earlier is no longer adequate. These changes are not discretionary. They are automatic. They are designed to protect the system, not the participant. This is where misunderstanding often occurs. Many assume forced selling reflects a change in belief. History shows otherwise. Forced selling reflects a shortage of liquidity. Participants may still agree with the long-term thesis. That agreement is irrelevant when margin calls arrive. In leveraged markets, time is not neutral. Speed matters more than direction. A rapid move in the correct direction can be more dangerous than a slow move in the wrong one. Volatility compresses decision windows. It removes flexibility. Silver illustrates this dynamic clearly. Because its market is smaller, incremental capital flows create outsized price movements. These movements increase volatility. Increased volatility triggers higher margin requirements. Higher requirements reduce effective liquidity. The cycle feeds itself. This is why silver rallies often contain sharp reversals, not because the underlying conditions have changed, but because the structure cannot absorb the speed of repricing without shedding leverage. The pullback from the mid-80s to the low 70s followed this exact sequence. Price rose rapidly, volatility expanded, margin requirements tightened, positions dependent on borrowed exposure were forced to exit. The move did not invalidate the underlying conditions. It exposed the limits of the structure. History shows that these moments are not anomalies. They are features of leveraged systems. During periods of stability, leverage accumulates quietly. Banks extend credit, funds increase exposure, governments expand balance sheets. This leverage appears sustainable as long as asset prices rise and volatility remains low. When a shock occurs, whether financial, geopolitical, or monetary, the process reverses. Deleveraging does not happen gradually. It happens simultaneously. Everyone seeks liquidity at the same time. This is the environment where silver becomes revealing. As leverage unwinds across the system, assets that depend on credit face pressure. Assets that do not depend on promises behave differently. Silver, like gold, is not a liability. It does not require repayment. It does not rely on institutional solvency. However, silver's smaller market size makes it more volatile during these phases. That volatility attracts leverage during the advance and punishes it during the reversal. This is why being correct about direction does not guarantee survival. History shows that many participants exit these cycles not because they misjudged the outcome, but because they misjudged the path. Timing and structure override narrative. This process results in transfer rather than destruction. Assets move from leveraged holders to liquid holders, from those required to act to those able to wait. This transfer occurs quietly. It is not labeled. It is recorded only in position data and balance sheets. Understanding this mechanism is essential because it explains why silver is both powerful and dangerous during periods of transition. It amplifies stress, it accelerates repricing, it exposes structural weakness before it becomes visible elsewhere. This is not a flaw in silver. It is a reflection of how modern financial systems operate. Leverage increases efficiency during calm periods and fragility during volatile ones. Silver sits at the intersection of that trade-off. History shows that when leverage unwinds, markets do not reward conviction. They reward liquidity. The pattern repeats. Changes in monetary perception do not occur evenly. They spread through networks. At first, only a small number of participants reassess assumptions. Most remain anchored to familiar frameworks. Over time, observable signals begin to circulate. Price movement becomes data. Data becomes conversation. Conversation becomes reconsideration. This is how perception shifts, not through announcements, but through observation. When silver rose sharply through 2025, the move itself became a signal. It forced attention, not because silver was unfamiliar, but because its speed was difficult to ignore. Rapid appreciation challenges assumptions about stability. It invites questions about what is driving demand beneath the surface. Institutional behavior during these phases follows a consistent pattern. Large portfolios rarely reposition aggressively at once. They test, small allocations are adjusted, exposure is added incrementally. In a market as small as silver, even modest reallocations produce disproportionate effects. This is not speculation, it is mathematics. Small markets amplify flows. As gold prices reached elevated levels, silver became a practical alternative for those seeking exposure to monetary stress without committing large amounts of capital. The shift did not require consensus. It required experimentation. A small percentage of large portfolios was enough to accelerate movement. This acceleration feeds perception. Rising prices validate concern. Concern draws attention. Attention brings additional participation. The process compounds. History shows that this phase is often misunderstood. Observers interpret rising participation as enthusiasm. In reality, it reflects reassessment. Participants are not responding to optimism. They're responding to uncertainty. Silver's role during these moments is frequently mischaracterized. It is not being chosen because it promises return. It is being chosen because it does not depend on confidence in policy outcomes. It exists outside institutional balance sheets. It does not rely on counterparties to perform. This distinction becomes critical when correlation increases across traditional asset classes. During periods of stability, diversification functions as expected. Assets respond differently to incremental changes. During periods of systemic stress, correlation converges. Stocks decline together. Credit tightens together. Property markets weaken together. History shows this convergence clearly during major disruptions. In such environments, diversification within the same monetary system provides limited protection. Assets that exist outside that system behave differently. This does not imply certainty. It implies difference. The distinction between thinking within the system and thinking about the system defines this phase. Many participants focus on optimizing returns under existing rules. Fewer consider the durability of the rules themselves. The difference is not intelligence, it is perspective. Silver attracts attention during these periods because it sits between accessibility and independence. It is tangible, yet liquid. It is scarce, yet divisible. These characteristics allow gradual positioning without dramatic commitment. They enable participation without concentration. This flexibility supports the perception shift. It allows reassessment to occur incrementally rather than abruptly. Participants do not need to abandon existing frameworks. They can test alternatives quietly. As this process unfolds, the market begins to differentiate behavior. Some participants treat volatility as opportunity. Others treat it as signal. The distinction matters. Opportunity focuses on timing. Signal focuses on structure. Those focused on opportunity attempt to optimize entry points. Those focused on structure pay attention to conditions. History shows that during transitions, structure dominates outcome. The concept of silver as insurance emerges during this phase, not as rhetoric, but as function. Insurance is not purchased because disaster is certain. It is purchased because consequence matters. The absence of certainty does not eliminate risk. It defines it. This framing alters behavior. Price declines are not interpreted as failure. They are understood as volatility. Rallies are not treated as confirmation. They are treated as indication. This is why perception shifts are slow until they are not. They build quietly through observation and reassessment. When the shift becomes visible, much of the adjustment has already occurred. History shows that markets do not change when everyone agrees. They change when enough participants quietly act before agreement forms. Silver's role in this process is not to lead opinion. It is to reflect movement beneath it. It translates abstract concern into observable behavior. This is the phase where asset transfer accelerates, not through panic, but through repositioning, not through collapse, but through adjustment. Those dependent on leverage respond to volatility. Those positioned for endurance do not. The process remains orderly. Institutions continue operating. Markets remain open. Life appears unchanged. The shift occurs beneath the surface. History shows that by the time transitions are widely acknowledged, they are already advanced. The pattern repeats. Every confidence-based monetary system eventually encounters a limit, not because participants lose faith arbitrarily, but because structure imposes constraints. History shows that when obligations grow faster than productive capacity, adjustment becomes unavoidable. Debt does not resolve itself. It is managed. When growth cannot absorb it, policy compensates. Monetary expansion becomes persistent rather than exceptional. What begins as response evolves into dependency. This is where mathematics replaces narrative. If liabilities compound faster than output, servicing them requires dilution. There is no alternative mechanism. Politics may delay recognition. Markets do not. Numbers enforce outcomes regardless of intent. This is why monetary transitions rarely appear dramatic at first. Institutions remain open. Systems function. Policy language emphasizes stability. Adjustment occurs quietly through revaluation rather than declaration. During these phases, volatility does not represent chaos. It represents transfer. Leverage exits first, not because it is wrong, but because it is fragile. Positions dependent on continuous liquidity cannot withstand tightening conditions indefinitely. When volatility expands, margin enforces discipline automatically. Those who entered exposure through borrowed means are forced to respond. Those positioned without leverage are not. This distinction defines outcome more reliably than conviction. History shows this repeatedly. During every major monetary adjustment, assets do not disappear. They change hands. from participants required to act to those able to wait, from speed to endurance. Silver occupies a specific role in this resolution. It is not the destination, it is the indicator. It reveals when systems are compensating rather than correcting. It reflects stress before consensus forms. And this is why silver does not conclude cycles. It participates in them. It moves violently during transition because it sits at the intersection of liquidity, leverage, and perception. When the next phase of volatility arrives, and history shows that it does, behavior will diverge. Those treating exposure as speculation will react to price. Those treating it as structural hedge will observe conditions. This divergence is not moral, it is mechanical. Markets do not reward patience universally. They reward liquidity during stress and endurance during transition. The distinction becomes clear only after repositioning has occurred. This is why the ending of these cycles is often misunderstood. Observers search for winners and losers. History shows that the outcome is redistribution. Assets migrate toward structures better aligned with prevailing conditions. Money does not vanish during these periods. It moves from leverage to reserve, from velocity to storage, from immediacy to duration. This process is quiet. It does not resemble crisis in real time. It resembles management. Institutions continue operating. Policy remains active. Life proceeds normally. Adjustment occurs beneath the surface. Silver's volatility during these moments is not evidence of instability. It is evidence of transition. It reflects the friction generated when confidence-based systems recalibrate. This is why attempts to time these movements consistently fail. Timing assumes predictability. Transition does not provide it. Structure does. History shows that those who navigate these phases successfully do not attempt to forecast outcomes. They recognize patterns. They understand constraints. They position accordingly. This video does not suggest inevitability of collapse. It documents continuity. Monetary systems rarely end abruptly. They evolve. They reorganize. They preserve underlying mechanisms while altering expression. Silver's behavior during 2025 was not an anomaly. It was consistent with this sequence: rapid appreciation, volatility, forced deleveraging, reassessment. The move did not represent conclusion, it represented exposure. As liquidity conditions continue to adjust, similar dynamics will recur across markets. Some assets will reprice violently, others will remain stable. The difference will not be narrative, it will be structural. History shows that preparation occurs before recognition. Those who wait for confirmation arrive after repositioning has occurred. This is not a story about silver alone. It is a record of how systems adjust under constraint. The pattern repeats.